Why is the concept of a margin of safety crucial for mitigating risks and ensuring long-term investment success? Welcome back to Plan Future AI Insight. I am your Investment DADA, and today we are diving into a principle that separates the legendary investors from the crowd, the margin of safety. It is a fantastic question, my friend. You are asking about the very foundation of successful long-term investing. Let me share what 20 years of experience has taught me about why this isn't just a concept, it's your financial life jacket. Bar graph understanding margin of safety, the simple way. Imagine you're buying a house worth 1 crore. Would you feel safer paying 70 lakhs or 1.10 crore for it? That 30 lakhs gap between what it's worth and what you actually pay, that's your margin of safety. In investing terms, we look at it like this. Margin of safety equals intrinsic value minus purchase price. When you buy an asset significantly below its true worth, you create a cushion. This cushion protects you from business mistakes, economic downturns like recessions, market irrationality, and most importantly, your own emotional errors during a panic. Numbers. Let's look at the real numbers. Take the HDFC Balanced Advantage Fund, regular plan, as an example. The market's current Nifty P/E is around 20.26, compared to its 10-year average of 21.5. By calculating the deviation, we see the market is about 5.8% below its long-term average. This tells us we have a modest margin of safety, not deep value, but a reasonable entry point for disciplined SEEP investors. Think back to the 2008 crisis. The Nifty P/E was at a peak of 28. Those who bought there had zero margin of safety and got crushed when it fell to 12.5. But in the 2020 COVID crash, when the P/E dropped to 17, safety-first investors calmly added to their SIPs because the margin of safety was finally there. Bullseye. The DADA 3-pillar framework. When I evaluate any investment, I run it through 3 pillars to check for that safety cushion. Pillar 1, quantitative. I look at the P/E and the sector averages. If a company like RT Industries trades at a premium to its sector, the margin of safety is minimal. In such cases, DADA says, it's better to wait for deeper value. Pillar 2, DCF valuation. If a stock's fair value is calculated at 500 rupees, but it's selling for 300 rupees, you have a 40% margin of safety. Even if your growth assumptions are slightly wrong, you're still safe. Pillar 3, qualitative, the character test. This is crucial. If a company has high debt or quality concerns, even if it looks cheap, the margin of safety is zero. Quality always trumps cheapness. Gem. Why it's crucial for your success. There are 4 reasons why this matters for your portfolio. You can't predict everything. COVID, wars, or sudden inflation. Margin of safety absorbs these shocks. The emotional buffer. When the market drops 20%, but you bought 40% below value, you stay calm. If you bought at the peak, you panic. Compounding protection. A 30% loss requires a 43% gain just to break even. Margin of safety prevents those devastating math traps. Time becomes your friend. With a wide margin, you can afford to wait 3 to 5 years for the market to realize the value. Rocket DADA's action plan for you. Here is what you can do this week. Step 1. Review your current holdings. Check the P/E of your stocks or funds against their 5-year averages. Step 2. For new investments, aim for a 15 to 20% margin below fair value. Step 3. Use regular mutual funds through your mutual fund distributor. During downturns, their guidance acts as your behavioral margin of safety, stopping you from making panic selling mistakes. Glowing Star DADA's wisdom of the day. Greater than margin of safety isn't just about buying cheap, it's about sleeping peacefully. It's like building a ship that can weather any storm. Even if the market throws its worst at you, your investments are built to survive and thrive. You've asked a question that 90% of investors ignore. That alone puts you ahead of the game. Remember, investment in the equity market is subject to market risk. Past performance does not guarantee future results. This is Investment DADA, signing off. Stay wise, stay invested, and build your future with confidence. Thanks and regards, Kaustav Bishwas from Plan Future. Visit us at www.planfuture.in for your AI-driven investment navigation. Folded hands.